Hello everyone, I'm Alex Wendling, and on behalf of my fellow analysts Dan Conklin, Brad Page, Will Levi, and Tom Saunders, I'd like to thank you for listening to our Burkenroad Report presentation on Superior Energy. In our presentation, we will give an overview of Superior, discuss our target price and valuation methodology, provide our investment thesis, discuss possible risks, and end with our future expectations for the company. Superior is a leader in the oil and gas services industry. The company provides well life cycle products and services, subsea and technical solutions, and onshore and workover services. The company operates worldwide, but specializes in the Gulf of Mexico and the United States. With the recent acquisition of Complete Production, Superior has nearly 14,000 employees around the globe. On February 7, 2012, Superior acquired Complete Production for $553 million in cash and approximately $75 million in shares, valued at $2.3 billion. Tangible assets acquired in the transaction were $752 million of current assets and $1.2 billion of property, plant, and equipment. As you can see in the revenue chart, this addition essentially doubled Superior in size and revenues. The addition of Complete Production gives Superior a strong presence in the U.S. land market. The company's onshore services are pressure pumping, fluid handling, and workover services. Pressure pumping consists of hydraulic fracturing, high pressure pumping, cementing and stimulation services, which are used to stimulate flow in oil and gas wells that have recently been opened. Fluid handling involves the process to obtain, move, store, and dispose of all the fluids involved in stimulating new wells, as well as closing and plugging them. Well workover servicing rigs handle installations, completions, and the sidetracking of wells. Superior meets customers' needs on subsea projects ranging from construction, completion, and end-of-life services for subsea wells. These services are specialized for individual customers and are broken down into pressure control services, completion tools and services, subsea construction, end-of-life services, and marine technical services. Pressure control services include training around firefighting, engineering, and well control services. Completion tools and services maximize production during the end of the well's life and controls the sand and filters necessary for well closure. Subsea construction handles the inspection, maintenance, and repair of rigs using subsea operating vessels and remotely controlled machines. End-of-life services tackle plugging and abandonment when wells reach the end of their profitable lives, as well as decommissioning and the dismantling of the rigs. The drilling products segment focuses on downhole drilling tools and surface unit rentals. Everything from the primary drill pipe strings and coil tubing to bottom hole tools like non-magnetic drill collars fall in this category. We are estimating the one-year target price from November 13, 2012 to November 13, 2013 at $28 per share. If 2013 goes particularly well for Superior, then we can plausibly foresee share prices as high as $33 per share. Superior's success depends on how well it can integrate itself with Complete, the demand in both Complete's and Superior's markets, and its ability to maintain cash flows and effectively manage its capital structure. However, if Superior experiences setbacks in integrating with Complete, or has hardships continuing to grow and pay off debt on schedule, the stock price could remain depressed. If Superior hits its target price of $28 per share, this will result in a return of 47%, compensating investors for the 36% loss recorded in 2012. We arrived at our target price of $28 per share using an equal weight of our DCF model, the PE ratio of Superior's closest peers, and the price-to-book value of Superior's closest peers. Our DCF model used free cash flow from operations and provided the most conservative estimates at 19.38 cents per share. The DCF uses our revenue regression estimates and predictions regarding growth rates and expenses. This lower valuation is attributed to the high capital expenditures the company incurred due to the complete acquisition. The capital expenditures reduced our free cash flow for the current year to a negative value. For our weighted average cost of capital, we use the beta of Superior relative to the S&P 500 Oil and Gas Index. Our highest one-year estimate of $36.39 per share came from the company's price-to-book value ratio. We considered book value to be an important aspect in our valuation because property, plant, and equipment and tangible assets are integral drivers of the company's revenues. Finally, we use the PE ratio as our final valuation contributor to take Superior's bottom line into account. The PE ratio gave us a company valuation very close to our one-year price at $26.86 per share. We give Superior Energy a market outperform rating and project a 12-month target price of $28 per share. The complete acquisition expands Superior's exposure to the U.S. land market, which helps the company diversify its customer base. 42% of Superior's total revenue is now generated from the U.S. land market. Superior expects to continue to grow its international presence. The company expects a 40% decrease in capital expenditures in 2013 and plans to use the excess cash flows to expand internationally into areas such as Latin America, Saudi Arabia, and West Africa. Superior recognized a 17% increase in international revenue in 2011 and has increased its spending on international expansion by 50% in 2012. We believe that the recent drop in stock price provides an attractive entrance price for investors. With Superior's heavy domestic presence in a down market, the company has been able to decrease its capital expenditures and expects to continue to do so into 2013. Superior has been using the excess cash flows to primarily further its international growth. Superior has also used its excess cash flows to pay off existing debt. The company has already paid $150 million on its next scheduled debt payment and plans to finish the payment in the early part of Q1 2013. Superior faces operational, regulatory, and financial risks as a company within the oilfield services industry. The company's operational risks include the number of plausible drilling prospects, commodity price expectations, and other factors such as natural disasters and operational hazards. Oil and gas prices do not directly affect Superior's operations, but they have a significant impact on exploration and production capital expenditures. Foreign operational risks extend into political and macroeconomic factors. Related issues include OPEC's influence on international oil supply, demand for energy, and foreign political conflicts in oil and gas-rich regions. Natural disasters also pose environmental risks. For instance, Hurricane Katrina significantly reduced the company's operations in the Gulf of Mexico for an extended period of time. Superior faces the potential for increased regulation in offshore oil drilling, onshore hydraulic fracturing, also known as fracking, and greenhouse gas emissions. The Deepwater Horizon disaster in 2010 prompted a 6-month drilling moratorium that impacted 33 major deepwater drilling operations. National and local government litigation still remains a concern, especially after Hurricane Isaac revealed some previously undiscovered oil from the 2010 spill. Superior's growth strategy carries inherent operational risks. Acquiring numerous companies and business segments requires large capital expenditures that are often financed with debt. For example, more than $1.3 billion was raised in senior notes for the complete production acquisition, and the full expected benefit of the acquisition might never be fully realized. Superior relies on access to the capital markets to fund different aspects of its operations, including maintenance and growth CapEx, acquisitions and mergers, and joint ventures. A sudden inability to raise funds through the capital markets would jeopardize Superior's ability to pursue profitable business opportunities and to respond to competitive pressures. Investors' appetite for U.S. corporate debt has remained elevated through the current economic cycle, which allows Superior to successfully issue long-term bonds. Current capital market conditions are favorable for Superior, but any credit crunch in the capital markets would have a negative impact on Superior's operations. Our expectations for Superior Energy are based not only on the company's operations, but also on the future outlook for the E&P and oilfield services industries. Exploration and production in the U.S. land market has significantly increased with the inception of non-conventional resource plays. The E&P industry is currently shifting capital expenditures away from producing natural gas and natural gas liquids towards an increased focus on oilier plays. We expect the industry to continue this trend towards higher oil basin capital expenditures due to the current glut in natural gas production. Until natural gas and NGL prices find an equilibrium in the market, E&P companies will continue to curtail their operations in some uneconomic gas basins. This reduction in capital expenditures has already led to a decrease in rig and well counts, and we expect this trend to continue into the first half of 2013. With the expansive reserves of newly discovered natural gas, new demand sources for this commodity are beginning to develop. Natural gas producers are already investing capital in new demand sources, including building infrastructure to support vehicles run on natural gas. Finally, we expect E&P operations in the Gulf of Mexico to see significant improvement in the coming years. Gulf of Mexico operations are continuing to ramp up after the moratorium, and we see this area as an integral part of the United States energy profile. Turning now to our outlook for Superior, we predict the company's stock price to rise to $28 per share. Management has given guidance on future capital expenditures for fiscal year 2013, and the main focus of capital will be in building international operations. Management has also indicated that they will see continued pricing pressure in the U.S. land market. With decades of experience with clients in the Gulf of Mexico, Superior is well positioned to take advantage of the increased Gulf of Mexico activity. Finally, the complete acquisition gave Superior a broad and comprehensive suite of new products and markets. This acquisition will strengthen Superior's ability to provide existing clients with a full range of services and solutions, thereby strengthening their client relationships. On a final note, we would like to leave our audience with the words of Kevin Davidson, an associate with Wells Fargo Energy Group covering Superior Energy. With the completion of the complete acquisition, Superior Energy has broadened its product set domestically, while maintaining a focus on growing its international presence. The international initiatives, in addition to increased exposure to the strengthening Gulf of Mexico market, has helped to mitigate some of the downward pressure on the U.S. onshore market. Thank you for joining us in our presentation on Superior Energy. We hope this was informative and helpful in your understanding of the company.